Hello, Steve Lentz here with Discover Options. Welcome to the Prepared Mind. Today we have two installments for you, a little bonus here. We're going to go over the S&P 500 Condor Butterfly Timing Report, and we're going to give you the Directional Likelihood Report as well. Great information for advanced options traders. If you like it all what you see here, we'd appreciate it if you would subscribe by just going to the button below. And also, if you like what you see here, you can read more about it at our blog entry. Frank Fahey does a great job every weekend. We post the blog kind of on Sunday night, just like this, at discoveroptions.com. Click the blog entry and you'll see there Frank's entry for the Prepared Mind. He includes also a list of candidates for double calendars related to earnings. So he covers volatility as well, earnings, and lots of great information for you advanced options traders. Finally, before we get to the report, we do have a ebook for you, Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. That's for free by going to, you can actually go to the link in the upper right, click that, and that'll take you to the place to obtain the free ebook. Okay? All right, let's go to the first of two reports, the Condor and Butterfly Timing Report. And this is just a preview of what you'll see coming up, this as well as the likelihood report. And we begin with the current condition of the market right now as of Friday's close. We define the current condition in three areas: price action, trend, and the overbought, oversold. Price action, we can see here that the high and low on Friday was underneath Thursday's highs and lows, and the close was underneath as well. In terms of trend, the close was underneath the 20-day simple moving average, but above the 200, kind of right in that little window that we can see that we're in right now. And in terms of the overbought and oversold, the 15-3 stochastic is under 50, and it is under its 3-day simple moving average. So this is a market condition that's very unique, and we like to address every day separately in terms of all three of these, and we just kind of like to see if it's more likely to be a good time to put on condors and butters or not. And so, is this current condition a good one for selling option premium? That's the question on the table. So how do we do that? How do we determine if it's a good time in this condition for selling premium? We begin by going to the 21-day actual percent move, and we plot this. And on the right side, we haven't had 21 days go by yet, and so we can only plot it as 21 days is revealed from any close. But you'll see pretty clearly that, say the most recent one we had, around the 13th or 14th right here of April, you can kind of see that over the course of the ensuing 21 days here, that it really didn't move very much, maybe 2% up and then channeled. So the distance here from, say, I think that's this close here, from this close, at all, we kind of moved, maybe it may move down maybe 2%. So not much of a move right there. So we like to plot the 21-day actual percent move, and then we plot the 21-day move that was implied at the time by the skew adjusted VIX. All right, so what I'm showing you here is the VIX, but in the background of all the algorithms we do a skew adjusted implied percent move, one implied for the upside, another one for the downside. Clearly you could see here that the implied move has been above the 21-day actual through March and on into April. Now what we like to do is, when you have a situation, let me get this, this is going to let me do it. When you have a situation here where, let me change colors. There we go, right there. Where the implied ended up being higher than the actual move, well, those were good periods of time to trade condors and butters right in here. All right. Now then, in periods of time like here where the market just blasted off here, well, that's where the actual move at that point was higher than the implied, and this would have been a very bad time to trade butters and condors. So we paint those bars red. The favorable ones we paint blue, the unfavorable ones we paint red. Now the black ones here, we don't yet know if they're going to end up being blue or red, because a full 21 days hasn't gone by yet. correct? Okay, so every day that goes by, oh boy, what did I do? Every day that goes by, I didn't want to do that here. Boom. Here we go. Let's see. Oh, that was interesting. That thing, zoom out. Boom. There we go. Every day that goes by, we end up painting a different bar, blue or red, as time goes on. Okay, next up. Okay, click. Boy, I invoked this draw thing, and it is just not letting me get out here. 1 second here. Boom, erase. Oh, I know. I'll click that button. There we go. So here's the question. Since January of 2000, what percentage of the bars have been favorable for selling premium in the S&P Cash Index options? All right, and that's kind of going to be our baseline in terms of the random historical benchmark for selling premium here. Look at this, 66.9% of all the bars since January of 2000 have ended up being blue bars, where they would have been, where the VIX was implying more volatility than what actually came to pass, which is what you want for selling condors, right? And for trading butterflies. About roughly 1/3 was very poor for trading those positions. 2/3 was really favorable. All right, so now, of those bars which align with our current technical condition, what percentage are favorable in terms of being blue? So what we're going to do is take a look at this technical condition, and you can see that I marked, there's 3 on the chart here that are meeting that condition. But if you went all the way back to January of 2000, there's between 1 and 200 bars that meet that condition. So of those, what percentage are favorable? And in this case, when you run the numbers, 62.3% of the closes in which our same condition that I already defined for you was met. Out of all those bars where our condition existed, 62.3 were blue. Now that's less than the random benchmark of 66.9, right? So we actually have a negative edge here. That this condition is more likely to generate more red bars than what is just random historical. Okay, so you could do better by just flipping a coin, basically, and hoping to get 2/3, 1/3 here. And the condition we're in, it's we're operating a little bit at a negative edge. Okay, so unless you have to trade, it would be not as favorable to trade right now as it would be in other market conditions where it's more likely that this condition would end up having a blue bar, having it end up turn into a blue bar 21 days from now. Okay, so that's the timing report. It's negative currently. Unless you have to trade, the statistics are saying that it would be less advantageous to trade now as in other conditions where you would have a positive edge. Okay, before we get to the directional likelihood report, want to point out to you, you could go to discoveroptions.com, take a look at our continuing ed group of benefits that you have, including our Inside Wire report every Tuesday morning at 11. I do a fairly advanced class with some of this type of research where we're trying to find the more precise, good markets and environments to trade butters and condors in. A lot of other directional stuff as well. We archive 300 to 400 of these types of sessions, and I think you'd find that very interesting. You can go take a look at the list and then decide. But we have a real good intro continuing ed course that I think you'll really like. If you're at all looking at mentoring, we have some advanced mentors that manage money themselves and could really help you if you need it. Okay, our directional likelihood report. There it is. I'm going to show you how we get into it and just give you kind of a gist as to what the market is more sinking than not to do. So we take our current condition. I already went over that. Underneath the 20, above the 200, we're kind of sinking down in the stochastics area there. Okay, so since January of 2000, how often has this same scenario occurred, and what did the market do after those? Now, we already examined the implied volatility, with the options, but we're just looking at straight market direction. Did it typically go up, down, or kind of wobble in the middle? And that's what we're going to do here. So we're going to understand the historical distribution of price. We're then going to look at the distribution after that condition was met in the past. Okay, and then we're going to see if there's an edge that exists, if the two are different by any significant amount. So let's first understand the historical distribution of price. Now here's how we do it. We set up 3 volatility bands, 5, 10, and 15 days. These bands are measured 1 standard deviation from each close. It's not like a Bollinger Band centered on a moving average. So from every close, we measure a standard deviation of, above and below out 5, 10, and 15 days. So we'll have 3 bands going on up and 3 bands going on down below underneath the close. We're going out 20. We're using the statistical or historical volatility from the last 20 days to determine the input for volatility to get those bands. These are log normally distributed, of course. Okay, so here's an example, real quick. 10-day bands. These bands are set 1 standard deviation above the close and below. These are 10-day bands using the 20-day historical vol. Now here's the question. From any close, is price likely to go up and hit the upper band, or go down and hit the lower band, or wobble in the middle? So from this particular close, it went up and hit the upper band. So for that close, we record in our database that it hit the upper band. Now the most recent close you see there in the middle, look at where the bands are. Did price go up and hit the upper, the lower, or stay in the middle? And in this case, if you look real close, it tried to go down and hit the lower band, okay, right there. And it tried to go down and hit that lower band, but it didn't quite make it. So in this case, within our database, we would put that it hit neither band. Okay, so from every close, we record how often price struck the upper and the lower 5, 10, and 15-day bands. And we record those percentages. And here's those percentages now. From January 2000 through May 13th of 16, okay, price would go up and hit the upper band 29.5% of the time, the upper 10-day band 23%, the upper 15 almost 23%. It would strike the lower 5-day band 30% of the time, 29.8%, and the lower 15-day band was 32.6%. That's 4,127 signals in total. Okay, so that is the historical benchmark. That's the historical, we could call it random distribution of price over a long, long period of time, but that's our benchmark. And ideally, wouldn't you think then that if a bullish signal were worth its salt at all, that they would strike the upper band more often? There would be a bias to the upside, or a bearish signal would give us a bias to the downside. So that's what we're seeking here. All right, so now we're going to take a look at our current condition and see if there's a bias in either up or down. We're going to understand the distribution like that only in those situations where that condition came to pass. And so here I I'm using Metastock, and I created an expert, highlighted all the bars in which that same condition as exists today is showing up on the bar here, or in the past. Then what I like to do is examine how price is distributed at the close, moving forward 21 days. What about those instances where the current condition exists and price goes above the high? Because come Monday, price could go above the high of Friday, and then you're wondering, well, I wonder if this is leaning bullish or bearish if it goes above the high. What if price goes below Friday's low? So we're going to report to you the distribution of price in each one of these 3 scenarios, just to give you a little bit of a head start on Monday. And here it is. As of the close on Friday, moving forward without any breaking, Friday's high or low, you can see here that the upper band gets struck a significant amount more often than historical random. So whereas random here on the upper 5 is 29.5, look at this, over 137 signals that this occurred. The same market condition existed over 130 times going back to January 2000. 44.5% of those 137 struck the upper 5-day band. 43.8% struck the upper 10, 40% struck the upper 15, which these three are much higher than these random historical, and that's why they're in blue here. So this is showing a bullish bias here on the blue there. Now, notice then that it struck the lower band a little bit less often on the 10 and 15. It actually struck the lower 5 about the same amount. So definitely a bullish bias after the close. Now, what if on Monday price exceeds Friday's high? Interesting how we have price also, we have the three upper bands getting struck more often. Okay, the lower bands are also struck more often, just barely a little bit, and the lower 5 is struck less often. So this is tell you that if we still have that bullish bias here, for sure. Now, what if it goes down below Friday's low? Look at that. It's still, okay, it still is hitting the upper bands a little bit more often, but it also hits the lower 5 and the lower 15 more often, just a little bit. This tells you that there's more volatility. If it's hitting both the upper and the lower bands the same or more, okay, in blue, you have just simply a greater amount of volatility going on. And so that's kind of what I see here, a slight bullish bias. But we also see the lower bands being struck more often in 5 of the 9 cases here for the lower bands. So this tells you that the market is getting a little bit more volatile than what the historical distribution is in this environment. But there's some bullish leanings here. Okay, and that's what we see. Now, some folks don't like to look at these bands being cast from using statistical volatility. They would rather see them cast using the implied volatility. So that's what we're going to do now. And you'll see here the VIX, or implied volatility, is generally higher than statistical. So since the VIX is higher than the statistical or historical vol, because that number's higher, the bands are going to be farther away, and then the bands are going to get struck historically less often. So the benchmark numbers here are lower than what you saw using statistical volatility, okay, by quite a bit. These upper bands and lower bands are getting struck far less often than using statistical. So, but we're going to run the same condition through, and we kind of see kind of the same thing. In this case, the upper 5, 10, and 15, they're struck more often, okay, than the other ones. And by the way, we're using skew adjusted numbers here, so that the upper bands are using a lower volatility than what is going into calculating the distance of the lower bands, the downside, the ones underneath the close. So a higher vol is used for determining the bands underneath the close, and that's because of the vertical skew. You know, you advanced traders in the SPX know the calls have lower IVs as you go out of the money than the puts do. So we're factoring that in here. If price goes above Friday's high, okay, same thing, a little bit higher on the upper bands, slightly higher on the lower, quite a bit lower on that 15-day, quite a bit, you know, a bit more volatility going on. And we now get to the, if it goes below Friday's low, the upper ones are struck a bit more. And look at this, gosh, look at that. If they go below Friday's low, the lower bands are getting hit less often. Look at that. Now, why is that? That's because if they go below Friday's low, vol is getting popped upward a bit. The downside volatility at 16.6, you can see there, that gets popped up even more, and so the bands are more difficult to strike. So more bullish bias all in all from both approaches that we look at. Now we do calculate the statistical there, upside volatility and downside volatility. So that's the report. Now what I'm going to show you now is just a suggestion. given that we have some bullish bias here on the likelihood report, let's look at a hedged bull put spread and the downside volatility from the VIX using the skew adjusted VIX 16.6. So we're going to keep that in mind as we look at a potential position here. And I like to carve up the VIX into upside and downside volatility calculations using the SIBO's skew and running that through an algorithm. I then plug that 16.6 up here in the Volti box in option view, telling us where the one standard deviation is, creating a nice bull put spread right there, but hedging it with the one little bear put spread up there at the money. You do that for a net credit here, so that when you go over here, then no matter how far the market goes up, you're going to make some money. In say 2 to 3 weeks, you'll make 4% or so, not too bad. And if the market goes down, well, then that hedge kicks in and really runs this out so that if you let it go to expiration, you can make a lot more on the downside than the upside. But this is kind of a safer way to trade bull put spreads, or even a lot of people think this is better than just condors because you sometimes just don't get very much money on the calls just because vol is so much less in those out-of-the-money calls. All right, perfect. Folks, thanks for joining us for this edition of The Prepared Mind. Love to see you back next week. Good luck trading this week. Take care. Enjoy the spring. Bye-bye.